It took the second largest bank collapse in American history exactly 48 hours to happen. Not 48 months, not 48 days, 48 hours. One tweet thread, one group chat, and one very bad bond trade, and a bank that had survived the dot-com crash, survived 2008, and banked half of Silicon Valley's venture-backed startups, was dead before most of its customers had finished their morning coffee. This is the story of Silicon Valley Bank, the bank that got too comfortable, bet on interest rates staying low forever, and found out the hard way that in the age of Twitter, a bank run doesn't take weeks anymore. It takes a group chat. Rewind to 1983, Santa Clara, California. A handful of bankers sit down over a poker game and decide the world needs a bank that actually understands technology companies. Because back then, nobody did. Traditional banks looked at a startup with no revenue, no profits, and a garage for an office and said, absolutely not. SVB looked at the same startup and said, sure, but we get warrants. That one decision built an empire. While Bank of America was busy financing car dealerships, SVB was writing checks to the companies that would become Cisco, Shopify, and eventually half the unicorns in Silicon Valley. By the 2000s, SVB wasn't just a bank. It was the plumbing of the entire venture capital ecosystem. Startup raises a Series A, money goes into an SVB account. VC fund closes, capital calls flow through SVB. Founders get their salary, SVB again. If you were a tech founder in California, chances are your payroll, your venture debt, and your personal mortgage were all sitting under one roof, SVB's roof. And for a while, that concentration wasn't a bug. It was the whole business model. Then 2021 happened. Interest rates were basically zero. Venture capital was raising money faster than founders could spend it. And every startup with a pitch deck and a dream was suddenly sitting on tens of millions of dollars in fresh funding. Where did all that cash go? SVB. In a single year, deposits at the bank nearly doubled, from around $60 billion to well over $100 billion. Founders weren't spending it, they were parking it. And SVB had a problem most banks would kill for: too much cash and not enough places to put it. So SVB did what banks do with idle deposits. It bought bonds. Specifically, long-term government and mortgage-backed bonds, locking in what looked like safe, steady returns for years to come. At the time, this looked boring, responsible even. Buy safe government debt, collect the interest, sleep well at night. There was just one small detail nobody wanted to think too hard about. Bond prices and interest rates move in opposite directions, and interest rates were about to do something they hadn't done in 40 years. Inflation is spiraling. The Federal Reserve, having spent a year insisting it was transitory, pivots hard and starts raising interest rates at the fastest pace in modern history. For most of the economy, that's a headline. For SVB, it's a slow-motion detonation. Here's the mechanic. SVB was sitting on tens of billions of dollars in long-term bonds bought back when rates were near zero. As rates shot up, the value of those old, low-yielding bonds cratered, because why would anyone pay full price for a bond paying 1.5% when new bonds were paying 4 or 5%? On paper, SVB's bond portfolio was underwater by billions. But here's the thing about on-paper losses. They only become real if you're forced to sell. And SVB was about to be forced to sell. Because at the exact same time, the free money that had flooded into startup accounts in 2021 started drying up. Venture funding slowed. Startups that used to raise and never touch their bank balance were now burning cash just to survive, and pulling deposits out of SVB to do it. The bank that got fat on a deposit flood was suddenly bleeding deposits during a rate environment that had wrecked its safety net. March 8, 2023. SVB does something banks really don't want to do in public. It announces it sold $21 billion worth of bonds at a $1.8 billion loss, and it needs to raise more capital, fast, to shore up the balance sheet. In a normal decade, this is a Tuesday, a capital raise, a rough quarter, move along. But this wasn't a normal decade. This was the decade of the group chat. Within hours, venture capital firms, the same ones who had encouraged their portfolio companies to bank exclusively with SVB, started sending one simple message to every founder they'd ever funded. Get your money out. Now. Not because they knew SVB was definitely insolvent, because they knew everyone else was about to think it might be. And in banking, a rumor of insolvency is functionally the same thing as insolvency, if enough people believe it at once. Founders don't wait around to find out who's right. Within a single day, customers tried to withdraw $42 billion, roughly a quarter of the bank's entire deposit base, in one 24-hour window. No bank on earth survives that. Banks don't keep your money in a vault. They lend it out, invest it, put it to work. SVB simply didn't have $42 billion in cash sitting around, because no bank ever does. By the morning of March 10th, regulators didn't wait for an official run to finish playing out. California banking regulators shut the doors and handed control to the FDIC. Silicon Valley Bank, 40 years old, tens of billions in assets, banker to half the startup world, was gone before the weekend even started. Here's where it gets interesting, because SVB wasn't just some regional bank nobody had heard of. It was the bank for an entire industry, and an industry with a lot of very loud, very online, very well-connected voices. Over that weekend, tech founders and investors didn't quietly wait for regulators to sort it out. They went on television, on Twitter, on every podcast that would have them, warning that if the government didn't step in, hundreds of startups wouldn't make payroll on Monday, that the entire tech ecosystem could seize up. Some of it was genuine alarm. Some of it was extremely wealthy people who happened to have uninsured deposits well north of the standard $250,000 FDIC limit, applying maximum public pressure to make sure they got made whole. It worked. By Sunday night, regulators announced an extraordinary step. Every depositor at SVB, even those with balances far above the insured limit, would get their money back in full, backstopped by the government. Technically, this wasn't a bailout of the bank itself. Shareholders and bondholders still got wiped out, but depositors, including some of the largest, most sophisticated investors in the world, walked away untouched. Critics had a field day. The same industry that spent a decade preaching disruption, risk-taking, and the market decides had just gotten the softest possible landing the moment its own money was on the line. SVB's collapse didn't stay contained. Within days, Signature Bank in New York failed too. Weeks later, First Republic, another bank beloved by wealthy clients, went down in the largest bank failure since 2008. The common thread across all three: heavy concentration in a specific type of customer, and a mountain of long-term assets that lost value the moment interest rates moved against them. It turns out safe government bonds aren't actually risk-free. They're just risk-free if you never need to sell them in a hurry. And in the smartphone era, in a hurry can now mean a single afternoon. Silicon Valley Bank didn't fail because of some exotic fraud, or a rogue trader, or a criminal mastermind cooking the books. It failed doing something almost boringly conservative, buying government bonds, and got caught in the one scenario that basic banking math says you should always plan for, and almost nobody actually does. What happens when everyone wants their money back at exactly the same time? For 40 years, SVB was the bank that understood Silicon Valley better than anyone. In the end, it was Silicon Valley, fast, networked, and allergic to sitting still, that ended it in a single weekend. The bank built its whole identity on being close to its customers. turns out that's also exactly what killed it.